Stock melt up with dovish Fed. The Federal Open Market Committee, FOMC, of the Federal Reserve unanimously decided to keep the federal funds rate unchanged. This decision aligns with market expectations, and the rate remains at 5.25% for the third consecutive meeting. The dot plot projections for future rate cuts showed a broad range of estimates, with a median prediction of a 75 basis point decrease. 8 officials forecast smaller cuts, while 5 anticipate deeper reductions. In a notable addition to their statement, the FOMC included a term indicating a softer approach towards further rate hikes. The Fed will consider the necessity of any additional policy tightening. The Fed also acknowledged that inflation has slowed over the past year but remains high, and economic growth has decelerated from its strong pace in the third quarter. For 2024 and 2025, the Fed slightly lowered its inflation forecasts, while unemployment rate projections remain mostly unchanged at 3.8% for 2023, rising to 4.1% in the following years. This suggests that Fed officials are increasingly confident in controlling price rises without causing significant job losses. Importantly, the core PCE inflation rate, which the Fed closely watches, is expected to fall to 2.4% by 2024. Additionally, the Fed has raised its forecast for US GDP growth. It now expects a 2.6% annual growth rate for 2023, up from its previous forecast in September. The 2024 GDP growth projection remains largely the same at 1.4%. The market responded well to the hints that the Fed might be done raising rates and could lower them up to 3 times in 2024. The Dow went up by over 500 points, and the NASDAQ increased by about 200 points. Edward Harrison from Bloomberg suggests that the rate market will continue to see fluctuations until the economy clearly exits recession. He believes the market is overly optimistic about the Fed's expected rate cuts, as it's uncertain when and why the Fed would start easing monetary policy. Harrison outlined 2 potential economic scenarios, one with slower growth but no recession and persistently high inflation, and another with a deep recession in 2024, leading to high unemployment and significantly lower inflation. In the former case, the Fed might need to raise rates again, while in the latter, it might refrain from intervening. Harrison emphasizes that the market should start pricing in the possibility of significant rate cuts, suggesting that the risk of recession has not completely dissipated. Jeffrey Gundlach from DoubleLine believes that the federal funds rate could decrease by 200 basis points in the next year. He is skeptical of the Fed's dot plot prediction of a 1% rate cut over 3 quarters, suggesting that more significant cuts might be needed if the Fed starts lowering rates. He predicts a recession in 2024 and expects the 10-year U.S. Treasury yield to drop to around 3%, aligning with significant Fed rate cuts. He notes the recent downward trend in the U.S. Treasury market, offering good buying opportunities for investors. Gundlach advises investors to opt for bonds slightly longer than T-bills and combine them with long-term bonds, expecting this strategy to yield good returns in 2024. He also anticipates funds gradually moving from money market funds and bonds into the stock market. Hit the subscribe button to make more videos like this. Thanks for watching.